JSW Steel came out with numbers on Friday evening, and on most counts, they have clocked in numbers which are better than the Bloomberg consensus estimates on the line items that matter the most to an investor. Let's get in. Mr. Jayant Acharya is Deputy MD of JSW Steel, joins us on the show to talk about how the quarter, how the year went by, and what is the outlook like possibly for the year ahead. Mr. Acharya, good having you. Thanks for joining in. And congratulations on a good quarter. Much ahead of what most estimates were, even as the line items would have shown the expected declines on the EBITDA front, for example. Did it turn out as per what you anticipated, or were there some negative surprises or some positive outcomes that you didn't anticipate?
So, Neeraj, pleasure to be here with you. Thank you very much for inviting me to the show. Yes, JSW Steel had a good set of numbers for quarter four. It was primarily a volume story, which was aided by a good growth in the Indian steel demand. Our Indian subsidiaries did quite well. Our international subsidiaries overseas did also well. Ohio had some good operational numbers for the month of March specifically, and for the quarter overall. It could not break even, but it reduced its losses. Baytown, however, did a good number, $25.7 million of EBITDA. Our Italian operations had a number of 13.5 million of EBITDA on the back of good rail orders from the Italian government, and we have a visibility of rail orders going ahead. So the overseas operations are looking good. Going forward, I would say that the Indian steel demand will continue to be the main driver for our growth as well. 85% of our business, by and large, is Indian denominated. And we see a possibility of India's demand growing by about 8%, so roughly about 10 million tons, and it would go up to 130 million tons for the coming year. So we see a good demand going ahead as far as India is concerned. The international demand may be a bit subdued primarily in the West, but we see pockets of demand coming out on shortfalls emanating from Russia and Ukraine. We have a coverage across locations. We cover about 100 countries for our exports. So we are trying to diversify that market as well.
So 85% seems okay for a better part of FY24 as things stand right now. For the remaining 15% of your business, could the slowdown impact be much larger than the green shoots in some pockets? Is it even possible to guesstimate that currently?
So if you were to look at the 15% number, which I mentioned, our export in terms of volume will not be very different from what we did last year.
Okay.
In spite of the fact that last year, you will recall that we had a lower number in terms of exports because of the export duty for major part of the year. So we have taken the subdued demand into consideration and kept a number for FY24, which is similar to the numbers which we have actually achieved in the last year. So therefore, we are keeping that contained. Our main focus, as I said, would be the India growth story. The Indian government capex now being aided by the private sector capex, which are coming on. Manufacturing capacity utilization we see at 73% plus. So therefore, investments by the private sectors have started. We see good traction on the renewable energy front, and the services side is doing well, so which would aid consumption demand. So India looks to be a bright spot as we enter this year, and we are very confident that the India story will be very good going ahead.
So selective capex, certainly, you would expect that a major portion of private capex comes on stream, hopefully, if it does in FY24. Would that be a bigger booster? Because I know selectively things are looking good. Railways, maybe Select Auto, Maruti and some of the others have announced some large capex and sales volumes looking okay, or the others. But it's not a full-blown capex drive, if you will. You expect that sometime in FY24, and if that happens, could there actually be upsides to what you are currently thinking about?
Yeah, so that's a good question, Neeraj. Actually, if you were to look at the capex spend expected to be in the range of 40 trillion rupees, let's say about $500 billion, it is considering a smaller capex spend from a perspective of about 15%, let's say, for the private sector. capex. This also does not include the capex emanating from MSMEs and SMEs. The local bodies have been captured to some extent. So there is a possibility that the capex could be higher. The capex this year, which has been declared by the government and which is estimated to add up to 40 trillion, including private, is the highest seen so far. And I would say that, okay, we would aim at this number and look at it going ahead. However, there could be an upside if you were to look at the numbers from a private capex point of view. It could take place more maybe in the second half as things stabilize in terms of an overall scenario.
Yeah,
international.
Cross all fingers for that. I didn't get the sales volumes number though for the quarter. You were expected to post 6.3 million MT. What is it that you've done, Mr. Acharya?
Yeah, so on a consolidated level, because I think it's better that we focus on a consolidated level because our value-added assets sit in the consolidated part. So on a consolidated business point of view, we did 6.53 million tons of sales, which was a growth of 16% in the last quarter. And we had a 23% growth of consolidated sales for the year as a whole at 22.39 million tons. So a good set of numbers, as I said, both quarterly and annually. Our value-added steel, 60% share, but in terms of volume, it grew by 17% for the year. Our automotive business for the year grew by about 36%, and our branded retail grew close to 40%. So we have been across the segments growing, and that's been the traction for our India growth story. Even in the appliances, where the demand you are seeing is really doing well, we have a big market share in that, and there also we have seen a 30% growth for the company for the year as a whole. So good traction from most of the segments in India where we operate.
Okay, and then hopefully the next year's number is much higher than 23 as well. The other aspect is the beat on the operational front. Now, I'm guessing as volatile as the input costs are, they would have played some part in doing this beat because expectations were about 15.2, 15.3%. You've come in at 17% operating margins. What went right? And some word and a word on the coking coal price movement, because that is something that most people are wanting to understand from you. What is your anticipation on that?
Yeah, no, that's a very good question because we did have the advantage of a lower coking coal price coming into the last quarter.
Right.
We guided flattish coking coal between quarter 3 and quarter 4. However, we had an advantage of about $6. The coking coal prices came to about $274 CFR India for us in our basket for coking coal blend. Going forward, I think into quarter 1, we see a slight increase, maybe between $10 to $15, primarily on account of coking coal prices, which went up during February and March, and that would flow in typically into the first quarter because we carry a 60-day plus inventory. And so we would see the benefit of lower coking coal prices as we speak today. Let's say from a February perspective of coking coal number to now, as we speak, the prices have dropped by $80 to $100. We see the benefit of a lower coking coal price coming into our business from June and specifically into July-September quarter. So that's the outlook given forward. I think I would also say that the coking coal supplies have improved. Supplies into China have improved from Russia and Mongolia in a big way. The weather disruptions in Australia have improved, and therefore we see a better supply globally of coking coal going ahead.
Sorry, so did I hear you correctly? You believe that things will improve from June when it comes to this aspect?
Yeah, on the cost side, yes. From June onwards, the benefit of a lower cost of coking coal will come in.
Got it. Okay. Last two questions. One is something that the street really wants to know is your sense about the ramp up in the iron ore mines. Can you share something, some color on this?
Yeah. So we currently our crude steel capacities which we have in the country, we have from our own mines about 41% being supplied to our steel plants. We have recently won 4 mines, 2 in Karnataka and 2 in Goa. We have also been declared a preferred bidder in one of the composite licenses in Maharashtra.
Yeah.
So this would add, I would say, without the Maharashtra asset, because that would take time, Karnataka and Goa has the potential to add about 4 million tons of iron ore per year, and that would take our share of captive iron ore consumption up. Our targets are to see that we integrate iron ore backwards. Minimum 50% and going up to 75% is our target of backward integration of iron ore. So we continue to look at iron ore options wherever they make strategic sense and fitment from a logistics perspective, and we will continue to bid for those.
Okay. My final question, and since we are at virtually at the start of FY24, though it's 45 days gone since then, or maybe slightly more than that, what do you feel about the cycle, Mr. Acharya, considering the fact that a lot of global experts tell me that the best place to be in steel currently in the world is India. And having said that, the world growth is not quite out there, even though admittedly you did mention that 85% of your business is India, but still the world growth and what happens there would play a part. So I'm just trying to understand, is there a definitive cycle in here? And if so, where is it that you think we are in the cycle?
I couldn't agree more that I think India is one of the best economies to be in today, not only for steel, and I would say that for most of the products, because it's a consumer market. And we recently, I think I read somewhere that the top 10 CEOs in the world believe that India is probably the market to invest in as we go into the next few years. We see a good potential for India to grow on the steel cycle as well. India is building its national infrastructure and its national assets. This is a growth for the country over the next decade. We feel that the per capita income in India will grow. The infrastructure capacities will grow. Manufacturing will grow in India for India and for the world. Renewable energy, we are getting into wind, we're getting into solar, we're getting into hydro, and as a country, we're looking at utilizing the energy of the sun, basically to harness renewable energy and produce hydrogen. I think from an overall perspective, if you see the opportunities are excellent going forward. We see the next decade to be a decade for India. And yes, we are in a good place, and I think a good place to be in for the industry and for the economy as a whole.
So independent of the commodity cycle, you would presume that business would continue to look okay as India continues to expand more and more in the manufacturing arena. Would that be a fair summation?
Absolutely. Medium to long term, India is a good story.
Okay, great. Lovely talking to you, Mr. Acharya. Thank you so much for giving us those insights, and look forward to talk to you more often.
Thank you so much. Pleasure.
The pleasure was ours, and viewers, thanks for tuning in.